Forecast being brought to you by Needham Coin and Jewelry Buyers, located at 317 Chestnut Street in Needham. They're the most highly recommended place to sell your coins, jewelry, gold, silver, and historical items. Call them at 774-766-3050. That's my forecast. I'm Mark Eisenthal.
If you're struggling to hear conversations, TV, or the people you love, now there's an easier, more affordable solution without spending thousands. Audion Hearing makes high-quality, rechargeable hearing aids starting at just $98, free shipping, and dedicated one-on-one support in the comfort of your own home. No doctor's offices, no pressure. Clearer hearing delivered right to your door. Join over 1 million happy customers hearing life more clearly. Visit audionhearing.com. That's AUDIEN hearing.com.
Broadcasting from the Kanowski-Bresney studios comes the radio medium Laura Lee Show.
I feel like you had to let him go.
Yes, it is. He was on life support.
You've taken on the burden for his passing. Is that true?
That is right.
There's something to do with a Barbie doll.
He used to stick the old school Barbie dolls in the cake.
Oh my God, you're giving me goosebumps right now.
The radio medium Laura Lee Show. Tune into your spirit every Tuesday at 4 p.m.
My name is Dale Pazinski. I volunteer with United Way to help the homeless in my community learn computer skills and build a basic resume. I don't just wear the shirt, I live it.
Give, advocate, volunteer, Live United. Go to liveunited.org. Brought to you by United Way and the Ad Council.
You're tuned in to Money Matters Boston, 1120 AM WBNW. This is WBNW, 1120 AM, the Money Matters Radio Network. This is the Money Matters Radio Network, WBNW 1120 AM and W275 CM FM. Concord, Boston, the Money Matters Radio Network.
Our Senators Edward Markey and Elizabeth Warren and Representative James McGovern are standing up for radio listeners like us by supporting legislation to keep AM radio in cars. They know the value of local radio in times of emergency. Now it's time for Congress to finish the job and pass the AM Radio for Every Vehicle Act. Learn more at dependonam.com. This message furnished by the National Association of Broadcasters and this station.
As a busy mom, my to-do list is full.
While we can't add more hours to the day, we do have a great resource to help.
Go Red for Women has information to help you and your family live a healthier life.
Visit goredforwomen.org/momlife today.
Hi, this is Mike Armstrong from the Armstrong Advisory Group. One of the biggest challenges in financial planning is seeing the full picture. When your investments are spread across multiple accounts, it can be difficult to know how much you actually have and whether your strategy is really working. You might be taking on more risk than you realize or missing opportunities to better align your portfolio. Bringing your accounts together can help create clarity so you can see your total assets, your true allocation, and make more informed decisions about your financial future. Our new guide is called Consolidating Investment Accounts. It walks you through how to get organized, simplify your strategy, and build a more complete financial plan. Call 800-393-4001 to get your free copy today. That's 800-393-4001, or you can request the guide by visiting armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services.
For many hardworking families and retirees, an energy bill comes with an impossible choice. Paying the bills, putting food on your table, and keeping your family warm in winter and your home cool for the summer. But it shouldn't be that way. For more than 40 years, Citizens Energy has made one simple promise: to help households afford life's basic needs. Through Joe for Oil, we help neighbors through the coldest winter nights. Now, we're building on that same promise with Joe for Sun, a new way to save on electricity year-round. Our solar projects are already in communities across Massachusetts and New York, helping thousands of households save money. For many families, that means saving up to 50% on electricity. No installation, no equipment, and you keep your utility company. Like my dad's program before, we keep it simple, helping lower your utility bill through community solar at no cost to you. Call 1-855-JOE-FOR-SUN or visit citizensenergy.com to see if you qualify. You've trusted Citizens Energy to show up when it matters most. We're still here, ready to help.
Sponsored by Citizens Energy.
This is Tucker Silva of the Financial Exchange Show, and I'm joined today by estate planning attorney Todd Lutzke with your Financial Exchange Quick Tip of the Day. And today, we're talking about the top estate planning mistakes to avoid. Todd, a lot of people create their estate plan, but there are some that don't actually transfer assets into it. Can you explain why this is such a big mistake?
Sure. I mean, I'm going to try to explain it both from a revocable and an irrevocable planning standpoint. With the revocable, if you don't put assets in there, you end up leaving them owned perhaps jointly if you're married, and designated beneficiaries and the like. But if everything goes to the spouse, when one dies, then you've completely avoided your estate plan. In other words, you've set your trust up, but you went around it by leaving everything to the spouse instead of going through it by funding the trust and cramming down the assets to shelter some from estate taxes on the first death, so there's less taxed on the second death. And ultimately, on the second death, if you don't plan, there could be a probate problem because everything would go to probate if it's in their own name. The other big reason is with an irrevocable trust, of course, not funding it also can result in estate tax problems by the same way it did with the revocable trust. But in addition to not funding them with the irrevocable, you don't even begin the 5-year waiting period to get the assets protected from the nursing home. So there's a much bigger problem not funding an irrevocable trust versus not funding a revocable trust. So make sure you fund your trust if you do your planning.
Well, luckily, Todd Lutzke and the estate planning experts at Cushing & Dolan have written a brand new guide that details the estate planning blunders to avoid. You can request this brand new guide by simply calling 866-848-5699, 866-848-5699, or you can request it from their website, legalexchangeshow.com.
The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing and Armstrong do not endorse each other and are not affiliated. The Financial Exchange is produced by Money Matters Radio and is hosted by employees of the Armstrong Advisory Group, a registered investment advisor. All opinions expressed are solely those of the hosts, do not reflect the opinions of Armstrong Advisory or anyone else. Investments can lose money. This program does not offer any specific financial or investment advice. Please consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong Advisory and the advertisers heard on this program do not endorse each other or their services. Armstrong and Money Matters Radio do not compensate each other for referrals and are not affiliated. This is the Financial Exchange with Chuck Zodda and Mike Armstrong. Your exclusive look at business and financial news affecting your day, your city, your world. Stay informed and up to date about economic and market trends, plus breaking business news every day. The Financial Exchange is a proud partner of the Disabled American Veterans Department of Massachusetts. Help us support our great American heroes by visiting dav5k.boston and making a donation today. This is the Financial Exchange with Chuck Zodda and Mike Armstrong.
Good morning. You made it to Friday here on the Financial Exchange. We've got a market in reverse this morning as we open up the show, but a busy show today. In the second hour of the show, we're going to be joined by Lawrence Ball. He's a professor of economics at Johns Hopkins, talking to us about the interest rate and inflation scenario we seem to be in right now. We've got the Money Matters mailbag at 11:30. Paul LaMonica from Barron's joining us. Yesterday, we had the biggest IPO of the year so far with a AI-related tech company that nobody had heard of prior to last week, unless you worked in AI, going public, and some perhaps irrational exuberance being seen in the tech market there.
No.
And President Trump returned from China. So I don't think we were anticipating quite as busy a week as we got this week, but between the inflation report from Tuesday and everything else that's been going on, it turned out to be. And so let's jump in there first before we get elsewhere with the visit to China, because that just wrapped up. First state visit of a sitting U.S. president to China. I don't remember since when, since the 2010s at least. And frankly, most went into this with pretty low expectations. I don't know that, post-visit, the results defied those low expectations by any stretch. Any sort of agreement on things was, fairly high level and no big details. I do think there was one. If there was one interesting piece of the meeting, it was about Iran, in my view. A few things happened on that front, none of which to me is a great indicator for where things are to come. But, generally speaking, the first day President Trump said that the U.S. and China agreed that the war in Iran should end, that ship traffic through the strait should be free, Iran shouldn't get a nuclear weapon. They highlighted that they tend to agree on those major items. But at the same time, what happened in Iran was the Iranian state media reported that they had released some 30-odd ships carrying products to China. It's unconfirmed how many of those actually, if any, actually navigated through the Strait of Hormuz. But at the same time that Iran has been saying, hey, we are going to control the Strait of Hormuz, and the United States is saying, no, we're going to blockade it and prohibit any ships that are using this, payment method and defined method of Iran's to navigate the Strait of Hormuz. We're going to prevent those ships from going. Very interesting timing, obviously, for Iran to say, oh, yeah, but we're allowing these Chinese ships while the president is on a state visit to China talking about the Iranian war. Very clearly not coincidental. So I found that to be an interesting power move, and unclear to me if those ships made it through. I haven't seen any reliable
It's been
reporting.
pretty widely reported that they did.
Okay.
And when I say that, I'm talking about the Financial Times, and I think I saw something in Bloomberg as well, Mike.
Which indicates that the United States was either unable or unwilling to blockade those ships, and that's obviously fascinating.
Well, we're not going to board a Chinese-flagged ship, right?
One would think.
Act of war?
Yeah. So
I don't know. I'm not a maritime lawyer, but
interesting dynamics there, obviously, and very intentionally timed, I believe, for those events. On the second day of the summit, China's foreign ministry released a statement saying that the U.S. should never have started the war in the first place, which does not directly contradict anything that was said by the president on the first day, but clearly indicates that the two don't see eye to eye on the U.S. vision of Iran and the Strait and everything else.
Well, forget about all the propaganda press releases and flowery statements coming out of both sides at the resolution of this meeting. Look at what markets are doing. Oil is up. Bond yields, interest rates, that is, on longer-term government bonds are way up, presumably reflecting anticipated additional inflationary pressure, and equities don't seem to like it. So markets seem to have rendered their verdict, Mike.
Yeah, I'm not sure that U.S. equities are responding to the China visit or the events
just
in
rates.
Iran by any stretch.
Maybe they're
but
responding
yes,
to rates. Rates go up, stock prices, all else equal, should come down, right?
Yep. We've cited this a couple of times, so I'll just throw this one out there too. There's a bet on Polymarket right now about the Strait of Hormuz and when traffic will return to normal. The bets on it returning to normal by the end of this month, by the end of May, is sitting at right now a 6% chance, so almost no possibility based on betting markets. And by June 30th, you're only looking at a 30% chance of that.
I haven't been part of your and Chuck's conversations for the past few days, but so enlighten me, maybe. Who has an incentive other than us? Who is urgently motivated to bring this crisis to an end?
A bunch of powers that don't have any influence on doing so.
China doesn't seem to. They can get through what they want to get through. That was the point in the article. I think it was in the Financial Times this morning. And of course, they enjoy us being bogged down there. I assume as a geopolitical adversary, it's in their interest.
Yeah, I don't like to give
up there because I'm asking you.
I don't like to give too much. I think far too often we look at China and say, oh, they're really taking advantage of this moment. I think there's an argument that given the shortages of all sorts of fuels, China may be able to expand their influence in the region further because of this. You've heard stories of Australian delegations and other Southeast Asian countries going to China requesting fuel reserves, and presumably there's some sort of trade there. I think you could make an argument that post this crisis, China stands in a good position to distribute all sorts of non-oil energy-producing infrastructure like solar panels, wind, etc. But they are also hurting. They are also seeing higher prices, and they're needing to draw down their strategic petroleum reserves, which is probably not ideally what they would like to do. The countries that are probably most incentivized to see this happen or to see a resolution come would probably be India, Southeast Asia, the poorer Asian nations that are literally cut off from a lot of these supplies. You saw commentary from Prime Minister Modi this week that farmers were going to be receiving 1/2 of their normal amount of fertilizer. You saw him request that citizens stop buying gold to see outflows. And then
I guess I meant among the big powers that actually have the
influence.
Weight to bring this to a conclusion. I'm not saying this will go on that China and even Russia want this to go on indefinitely, but seeing us twist in the wind and drained is probably.
I think Russia's a clear beneficiary.
Yeah, for energy price reasons.
For energy price reasons, they are benefiting.
And China,
from this
as you
in the
said,
moment.
they are building.
Yeah, it hurts them, but they are building
handing
influence
out chips,
because
influence
of it.
chips.
Europe,
influence chips.
If they could get any sort of degree of act together in terms of their influence and a coherent message from European nations that seem to disagree on anything, would be another one that's severely.
Well,
hurting
they seem to agree on this. They're
Yeah.
angry they weren't consulted to begin with, and then resent being asked to come in and help out, and then told, "Oh, we don't need you."
Mm-hmm. But
comedy of errors, Mike. I'm sorry on our part. Comedy of errors.
Let's take a quick break. When we come back, a bit more on this trip to China, but then I want to get to this blockbuster IPO, Cerebras, the company that went public yesterday, and how investors reacted. That's next on the Financial Exchange.
The Financial Exchange streams every day live on YouTube. Subscribe to our page and follow the markets all morning long. Only here on the Financial Exchange Radio Network.
Hi, this is Mike Armstrong from the Armstrong Advisory Group. One of the biggest challenges in financial planning is seeing the full picture. When your investments are spread across multiple accounts, it can be difficult to know how much you actually have and whether your strategy is really working. You might be taking on more risk than you realize or missing opportunities to better align your portfolio. Bringing your accounts together can help create clarity so you can see your total assets, your true allocation, and make more informed decisions about your financial future. Our new guide is called Consolidating Investment Accounts. It walks you through how to get organized, simplify your strategy, and build a more complete financial plan. Call 800-393-4001 to get your free copy today. That's 800-393-4001, or you can request the guide by visiting armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services. It's important to update your estate plan as changes occur in your life, or you can wind up with significant issues that may affect your future. Get Cushing & Dolan's new guide called Detour Ahead, Estate Planning Potholes to Avoid. Call 866-848-5699 and get your copy today, or request it online at legalexchangeshow.com. The proceeding was paid for, and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and/or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated.
Hi, I'm Michael Valila, Adjutant of the Disabled American Veterans Department of Massachusetts. The DAV of Massachusetts provides thousands of hours of voluntary services at our VA medical centers and soldiers' homes, and is the only DAV department in the country to lead a veterans housing initiative for both single veterans and those with families. These programs are critical to serving our veterans in their time of need. You can help our great American heroes by making a donation today. Please visit dav5k.boston. That's dav5k.boston.
I was 24 when I had a stroke. I was 35 when I suffered a heart attack.
I was 46.
I was 62.
It's a fact. Cardiovascular disease is the leading cause of death in women.
But we can fight against our #1 killer.
Talk to your doctor about your risk factors.
Know your family history.
Learn the warning signs and symptoms.
Together,
let's go red for women.
Visit goredforwomen.org to learn more.
Here at the Massachusetts Department of Elementary and Secondary Education, we are committed to all students not only attending, but succeeding at school. Your presence is powerful. Share why you attend at doe.mass.edu.
Sponsored by the Massachusetts Department of Elementary and Secondary Education.
Our Senators Edward Markey and Elizabeth Warren and Representative Stephen Lynch are standing up for radio listeners like us by supporting legislation to keep AM radio in cars. They know the value of local radio in times of emergency. Now it's time for Congress to finish the job and pass the AM Radio for Every Vehicle Act. Learn more at dependonam.com. This message furnished by the National Association of Broadcasters and this station.
When a heart stops, the clock starts. You are the first responder until help arrives. In that moment, 4 minutes equals brain damage. 6 minutes equals too late in an emergency. The CPR. Visit heart.org/nation. That's heart.org/nation.
Find daily interviews and full shows of the Financial Exchange on our YouTube page. Like us on YouTube and get caught up on anything and everything you might have missed. This is the Financial Exchange Radio Network.
Well, we were having some technical difficulties earlier, but Chuck is back. And Chuck, when it came to the U.S. visit to China, President Trump's visit to China, I found the most interesting thing to be what was and was not said regarding Iran, the ship movements over the course of the last couple days through the Strait of Hormuz, and then the commentary from China's foreign ministry. But I may just be too focused on the events in Iran to pay attention to the other items. What takeaways, if any, others did you have from the state visit to China by President Trump?
Well, I think when you look at this, over the course of President Trump's 2 terms, we've had, what would you say, maybe half dozen to like somewhere between 6 and 9 of these that we've had?
Summits of some sort, conversations, whether they were in China or not. Yeah, probably somewhere in that range.
Somewhere in that ballpark. It's hard to say that this one is anywhere near the most important in terms of the outcomes that we've seen. I don't think there's much in the way of tangible takeaways for either side. And I think that's probably by design, and that I think both sides largely went into this with a fairly defensive posture, not wanting to ask the other for too much, simply because that would open them up to needing to have something, that they need to give as well. And so I just don't think that there's that much to really take away from this. It's like, again, I don't know that you can point to any level of meaningful progress that was made. I don't think that's a bad thing. It means that, you didn't necessarily give away anything that you didn't want to, but I'm just not sure that there's anything tangible here. We'll see over the next few weeks and months if maybe there's something behind the scenes that, was not necessarily announced that ends up coming to fruition, in any other realm, such as, the Middle East or, currencies or whatever it might be. But on the surface, it doesn't really look like there's anything overly consequential that came out of this, and that's fine. There doesn't have to be, but I think, as we said going in, expectations should be pretty low for this one, given the broader context of what's going on in the world.
Right. Yeah, that's kind of my takeaway as well.
So I think that's kind of where we land on this. Let's turn now. I touched on the Middle East briefly there. We got a piece in the Wall Street Journal. It's titled, "The World is Burning Through Its Oil Safety Net." Mike, have they been listening to our show for the last month?
Yeah, seems like it.
It's nice to see this piece finally published. I mean, look, you're seeing a handful of these that are making their way out in the last week or so, but we've been on this for a couple of months, and it's only now that the rest of the world seems to be waking up to this in any meaningful way.
So when we look at the kind of critical points here, I think it's, first of all, I don't think you and I have a, immediate certainty precisely when the United States oil reserves would run too low to get them pumped out. But I think it's pretty clear based on actions in places like India that plenty of places in the world are very aware of the massive shortage that is coming through just now and how disruptive it could be. In India, if you didn't see over the course of the last week, Prime Minister Modi has basically cut fertilizer supplies in half. He's asked its citizens to stop buying gold. He has encouraged different types of, or he's encouraged people to stop commuting and work from home instead. Big pushes to try and curb the demand side of the equation for all sorts of different energy supplies and other stuff coming out of the Middle East. What does the timeline look like to you when it comes to U.S. stockpiles? Because J.P. Morgan had their estimate from this week that was pretty stark.
Basically, it's going to be sometime in the back half of the summer. It's, that's kind of where it is. In particular, parts of the system are going to start to show stress in the next 4 to 6 weeks. So by the time we get to the busy 4th of July holiday for driving, you're going to see, more stress that's popping up. But it's, realistically, you're probably talking somewhere in the late July to early September range. Mm-hmm. And ultimately, look, every day that you go is a day that you can't get back for trying to mitigate the damage on this. And we're past the point of no return now.
Yeah.
There is no button that you can press right now that will prevent the U.S. system from reaching minimum operational levels later this summer.
Which means what for you and me? Right? I want to just purely understand this because I think there's visions in some people's minds of the 1970s gas lines, and I'm not sure that's
parts
really
of the United States will have that.
Okay.
California will not have enough fuel because they have to import a bunch from either Asia or the Middle East, and there is no surplus there. There's a decent chance California has fuel shortages this year.
That'd be so wild to think about.
The rest of the country, where you are probably heading, is towards energy prices that are, again, I don't know exactly where. No one does because we've never had this happen before. I wish we could get through 1 year without saying that, but we haven't had one of those normal years since 2019, so it is what it is. But where you're heading, again, I know this sounds crazy, and again, I hope that we can all just laugh and be like, oh, Chuck was wrong, haha, that. It's fine. I'll happily be wrong. I think there's a realistic chance that you see gas by the end of the summer somewhere in the $6 to $8 a gallon range. That's potentially where you are heading now, because here's how this works, actually. When you get down to those minimum operational levels, and even just before then, remember that you can't sell those barrels that you need in order to keep line fill and pipelines and things like that. Those need to be there. So if you keep prices where they are, then you have more bidders who come in and say, yep, I'm willing to pay this because I've got no oil. I need to buy up that crude and I need to buy up that product. Well, then you can't deliver all of the barrels that they want at that price because those barrels don't exist. So what has to happen is you have to get to the point where prices rise such that those buyers, whether for crude or for finished products, say, no, that's just too expensive. I just can't do it. And it's no different from anything else that anyone buys. Mike, if I could offer Americans a car for $6, I would sell a ton of cars, right?
If you could produce many of them, yeah.
But there's a way smaller demand at, an average price of $48,000, and so we sell about 15 million vehicles a year instead of 300 million at $6 a car.
Sure.
It's the same thing with oil. I can sell, X million, 20 million barrels a day of, product at prices of, 150 a barrel when you're talking, finished product and this and that. If that price rises to 225, hey, there are buyers who are going to say, no, I can't do that. It doesn't make sense. And so demand comes down. That's what we call, demand destruction. So ultimately, the U.S., I don't think we'll see shortages throughout most of it because we produce a lot of oil and a lot of refined product. But when you do get to the point where these, stockpiles are exhausted, you're talking about needing price to rise in order to meet that. And again, you're probably talking somewhere in the range of another 30 to 60% in pricing, which means you could potentially get in that $6 to $8 range if and when this happens.
Yeah. So, look, race against time to get the straight open, but a lot of this is kind of already done. And as we're seeing out that, I don't know, it seems hard to believe based on where we are today that traffic returns to normal by the next 45 days. And if it doesn't, it does feel like a pretty high likelihood that we go in the direction that you're describing. So, yeah, It is one of those things you hope you're wrong on, because it would be tremendously destructive to the American household. And life-threatening in other parts of the world is the really scary part.
Yeah, I mean, look, I think the vast majority of Asia is already feeling this right now, and it's only going to get worse over the next month or so. Europe is about a month or so behind that. We're about another month or so behind. So it's this thing that's just moving from east to west, and this is where we're going. Let's take a quick break here. When we come back, we've got Wall Street Watch next.
Like us on Facebook and follow us on Twitter @TFE Show. Breaking business news is always first, right here on the Financial Exchange Radio Network. Some of the biggest estate planning mistakes are the ones you don't even know you're making. At Cushing & Dolan, they've seen it all. Plans that aren't complete, that only rely on a will or lack of funding of a trust. These are the kind of mistakes that can lead to probate, unnecessary taxes, or even putting your assets at risk. As your life changes, so should your estate plan. Marriage, grandkids, new assets, and even changes in tax law can impact how your plan should be structured. That's why Cushing & Dolan created a brand new guide called Detour Ahead, Estate Planning Potholes to Avoid. It walks you through the most common and costly mistakes and how to help protect your assets, your family, and your future. Call 866-848-5699 to get your free copy today. That's 866-848-5699. Or you can request the guide online at LegalExchangeShow.com. The proceeding was paid for, and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and/or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated.
In Massachusetts, summer starts at the farmers market. Longer days, fuller tables, and the best local food coming in fresh each week. Find just packed produce, responsibly raised meats, small batch cheeses, fresh caught seafood, and thoughtfully made goods. It's where neighborhoods come together and local food shines. Stop by your market this season and support farmers and makers across the state. Sponsored by Mass Farmers Markets. Growing farmers markets across Massachusetts. Find your local market at massfarmersmarkets.org.
In a heartbeat, you could be the difference.
Mark collapsed from cardiac arrest.
9 out of 10 people who suffer cardiac arrest outside the hospital don't survive.
It took 30 minutes of chest compressions to finally feel a pulse.
Most of the time, it's because no one nearby performs CPR. But together, we can change that. Extraordinary things happen when people take action. A small step, a simple skill, a life-saving moment. HeartWalk brings communities together to create health and hope for every heartbeat. Every walker who joins HeartWalk, every dollar donated, means more people trained in CPR, more research, and more life-saving moments for everyone. Take the first step and register for your local HeartWalk. Extraordinary starts with you. Join HeartWalk today. Find your local HeartWalk at heartwalk.org.
Environmental nonprofit Ocean River Institute is working with communities to tackle climate change with nature-based solutions that feature slowing water down and building more soil with grasses and plants. Research indicates that people acting in their own neighborhoods can build an inch of soil in a year and slow sea level rise down by as much as 25%. Please visit oceanriver.org for more information on opportunities to make a difference and go the distance for savvy stewardship of a greener and bluer planet Earth.
Hi, this is Chuck and Mike from the Armstrong Advisory Group, and we have a guide available this month titled Consolidating Investment Accounts. Mike, how does someone end up with just this sprawl of different accounts over time?
We've all seen it before with family members or even ourselves, but according to the BLS these days, the average person stays at a job fewer than 4 years. And so imagine you're job hopping from place to place. You might have a retirement plan through there. And all of a sudden, a decade into your career, you could have 2 or 3 different retirement plans just from, changing jobs and taking that next promotion at a new place.
It doesn't even just happen with different retirement or investment accounts. It can happen with bank accounts or insurance policies. You can end up with stuff scattered everywhere.
Well, we all know that, that aunt or that family member that is always scouring for the best CD rate or interest rate on the savings account, or, has some money with this broker and this financial services company. And all of a sudden, you can be looking at a situation where over the years, you have a dozen different places where you keep assets, and that becomes more and more complicated to ensure that your spouse is on there, that you have beneficiaries aligned properly, and that you can actually monitor these things.
Folks, our guide is titled Consolidating Investment Accounts, and there are two ways that you can request it. The first is by calling 800-393-4001. The second is by going to armstrongadvisory.com. That phone number again is 800-393-4001, or you can request it online at armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services. Time now for Wall Street Watch, tracking the stocks, the data, and the headlines driving markets so far today, right here on the Financial Exchange Radio Network.
Well, markets are selling off as Wall Street pumps the brakes on the recent tech rally, with several chip makers, including NVIDIA, AMD, and Intel, seeing losses. Sentiment also lower after the summit between President Trump and Chinese President Xi yielded no major policy developments. Right now, the Dow is down 0.7%, S&P 500 down about 0.9%, NASDAQ selling off 1.25% or 330 points. Russell 2000 down nearly 2%. 10-year Treasury yield up 10 basis points at 4.566%, and oil up nearly 3% higher, trading at $104 a barrel. Well, after its NASDAQ debut yesterday, shares in chipmaker Cerebras down by 4% today. Yesterday, the stock surged 68% to close at $311 a share after it opened at $185 a share in its IPO, valuing the chipmaker at about $95 billion. More on Cerebras with Chuck and Mike coming up here. Meanwhile, shares in Applied Materials down by 2% despite the semiconductor equipment maker beating second quarter expectations on the top and bottom lines. The company also said it expects stronger sales this year than it previously forecasted as it continues to see strong demand for AI computing. And Starbucks announced another round of corporate layoffs this morning, about 300 in the U.S. This marks the coffee chain's third round of layoffs since CEO Brian Niccol took over. Starbucks stock is up by 2%. I'm Tucker Silva, and that is Wall Street Watch.
Mike, as Tucker mentioned, yesterday we got the big old Cerebras IPO. They raised about $5.5 billion. The market cap is now around $67 billion, which, again, for a company that, again, no one had even really heard of a year and a half or 2 years ago. This is pretty wild. And if you're not familiar with what they do, you're not alone. But they are a company that makes semiconductors, specifically processors for inference in AI usage. And I think, look, the more competition that you can get in this space, the more it's going to end up driving costs down and producing, better outcomes overall. It certainly is, crazily priced when you look at the actual, either revenue or profit of the company. But look, again, this is a company that did $171 million in revenue in the last quarter, and now is valued at $67 billion. So, price to sales is steep. Price to earnings, obviously even steeper given that they're not profitable. But this is, I still think, a good thing in that, hey, you want more competition in this space. It is going to help deal with the crazy level of demand that you have right now for these products.
Yeah, look, I welcome the competition. I'll also note that nobody had really heard of NVIDIA than gamers until the last, 5 years?
I'd say mid-2010s, people started to pick them up. They were more of a play on, either, autonomous driving back then, as well as cryptocurrency mining. So, they were starting to get some play in 2015, 16. But before that, look, they made graphics cards for computers. That's what they did.
The closing price on this company on Thursday values it at around 134 times its revenue for the past 4 quarters. That's
Steep.
backwards looking. Just to put that in context, it's about 5 times NVIDIA's multiple on the same metric. So that's just a little bit of context for you. I'd also, there's this Wall Street Journal piece today. The blockbuster Cerebras IPO is a huge bet on NVIDIA fatigue. Not sure maybe over the long term it is, but, up until today when, NVIDIA is moving down, as is Cerebras today. But this week, NVIDIA moved up 10%. The day of the IPO, NVIDIA moved up 4%. I'm not sure I can look at this and say, oh, yeah, this is investors jumping ship from NVIDIA and buying this other company. It seems to be more the exuberance for any company in the space that has a path to supporting the AI industry regardless of their. That piece is more concerning to me than it would be if investors were being nuanced and saying, hey, I'm taking some profits from this chip company and deploying it with this other chip company.
Now, the question that you always do wonder about with, any IPO that is, notable, is this marking, a local top for that particular industry? We saw this a bunch back in 21 and 22. Whether you're talking, Robinhood's going public, and that was kind of the short-term top for, meme stocks and crypto and stuff like that. We've seen it in other cases as well where that happens. And so you do look at this and you say, hey, is this something that represents, maybe a short-term top in semiconductors? It does seem like there's enough, demand out there that, hey, even if there's some wobbles after a crazy, 70% monthly, month and a half run that semiconductor stocks have taken, hey, you can, after, consolidating and maybe a little pullback, there's probably, there's potentially still upside there. But you do look at this and say, hey, is this something that indicates maybe we're getting close to, a short-term top when it comes to semiconductors?
Yeah, well, I think we'll have a few more tests this year in all likelihood, because I don't believe that Cerebras will be the last AI-related or the last company that claims to be AI-related to go public this year. We have a few that are on the list, and it's not definitive that they'll be able to go public, but this one, however it turns out, the IPO itself, pretty darn well timed. Again, this company priced their IPO in the low hundreds range initially. By the time they made it through underwriting, they upped it to 180. Was it 185 or 65 a share?
He dropped off.
I think it was 185, and by the time it was trading, was up near the high 300s. And so clearly a lot of excitement about this one, but we have SpaceX that's talking about an IPO of $2 trillion this year. We have OpenAI that wants to go public. We have Anthropic that wants to go public. So there will be likely more tests as to what the appetite is for these low or no profit and AI-related growth stories throughout the rest of this year, Chuck.
Yeah, and again, I think we've had a few tests in that AI space over the last couple of years, and each time it's been, kind of a 3 to 6 month pause, and then you see that next catalyst, and they're able to take that next leg up. So we'll see if that's the case here when it relates to semiconductors. The big thing that I think is still an open question, at this point, is for all those hyperscalers. Yes, they've bounced off their late March bottoms, just like everything has. But, you take a look at Microsoft stock, it still is 20% off its highs from last year. You take a look at Meta stock, and it is still 20% off its highs from last year. The only one of the big guys that's been able to make headway has been Google, or Alphabet, whatever you want to call it. And that's partly because they are on the semiconductor side, too, with their – Google's got, what is it, the Trainium set of chips? Or is it the TPUs? Google's the TPUs that they have.
I think so.
So like they've got some things that they're doing on that side as well. But otherwise, the big hyperscalers are are not necessarily in a great spot. I mean, Oracle is still, 40% off of where it was. Amazon, let's see, where are you hanging out? Amazon's bumped, but again, Amazon, different business also, and they've got their Tranium chips. Again, they're on the semiconductor side too. So I think that the jury's still out on whether the actual model makers are going to be able to figure this out. But the companies that they're buying the hard product from, yeah, there's been no questions there yet.
Yeah.
Let's see. Let's take a quick break. When we return, let's dig in more on the SpaceX IPO. We're expecting to get some information next week. We'll talk to you about what is coming next.
Remember, you can watch the show live every day on our YouTube page. We've got market updates and breaking business news all morning long, plus a full archive of all our show's content. It's all there with the click of a button at youtube.com/The Financial Exchange Show. Long-term care costs can reach thousands of dollars per month and can put a serious strain on your savings. The experts at Cushing & Dolan often see families caught off guard by that reality. Without the right plan in place, those costs can quickly eat through a lifetime of your hard work. But here's the shocker. Many estate plans don't protect your assets from those expenses. The right strategy may involve specific types of trusts designed to help protect your assets, but timing matters. Cushing & Dolan has a brand new guide called Detour Ahead, Estate Planning Potholes to Avoid. It breaks down some of the most common and costly mistakes people make and explains how to help protect your assets, your family, and your future. Call 866-848-5699 to get your free copy today. That's 866-848-5699. Or you can request the guide online at LegalExchangeShow.com. The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated.
Hi, this is Chuck from the Armstrong Advisory Group. If your financial life feels scattered, you're not alone. Over time, it's easy to end up with accounts in different places. Old retirement plans, different banks, multiple apps. It's what we call account sprawl. When you've got your money across the spectrum, things can get missed, like overlapping investments, and bringing everything into focus allows you to spend less time tracking accounts and more time making smart decisions. Our new guide is called Consolidating Investment Accounts, and it may offer strategies that can simplify your overall financial picture. Call 800-393-4001 to get your free copy today. That's 800-393-4001, or you can request the guide at armstrongadvisory.com. That's armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services.
For many families, an energy bill can mean difficult choices, wondering when or even how it will get paid. It shouldn't be that way. For more than 40 years, Citizens Energy has helped families afford life's basic needs. First, through Joe for Oil, and now through Joe for Sun. A simple way to save on electricity at no cost to you. No installation, no equipment, and you keep your utility company. We keep it simple and help you lower your utility bill. Call 1-855-JOE-FOR-SUN or visit citizensenergy.com to see if you qualify.
Sponsored by Citizens Energy.
Our Senators Edward Markey and Elizabeth Warren and Representative Lori Trahan are standing up for radio listeners like us by supporting legislation to keep AM radio in cars. They know the value of local radio in times of emergency. Now it's time for Congress to finish the job and pass the AM Radio for Every Vehicle Act. Learn more at dependonam.com. This message furnished by the National Association of Broadcasters and this station.
When a heart stops, the clock starts. You are the first responder until help arrives. In that moment, 4 minutes equals brain damage. 6 minutes equals too late in an emergency. The first responder is you. We need you. Will you be ready? Learn CPR. Visit heart.org/nation. That's heart.org/nation.
Let's talk LDL. AKA bad cholesterol. The higher your LDL cholesterol, the higher your risk of a heart attack or stroke. Your health matters. Know your number. Talk to your doctor and get your cholesterol checked. And learn how to help lower your LDL bad cholesterol. Because your health is in your hands.
Find out more at heart.org/LDL.
Missed one of our shows? Catch up anytime by asking your Alexa smart speaker to play The Financial Exchange. This is the Financial Exchange Radio Network.
The Financial Exchange is a proud partner of the Disabled American Veterans Department of Massachusetts. Register today for this year's DAV 5K on Saturday, November 7th at Fort Independence on Castle Island. If you're not able to participate, you can still support our great American heroes by visiting dav5k.boston and making a donation today. Your participation helps provide vital services like free transportation to medical appointments and safe housing for single veterans and their families. Donate today at dav5k.boston. That's dav5k.boston.
Mike, we're probably somewhere in the range of 3 to 6 weeks away from the SpaceX IPO. I believe we're scheduled to potentially get the prospectus for it within the next week or so. A lot of excitement building towards this puppy.
Well, we're talking about a $2 trillion company and $2 trillion attempt for their IPO. And, frankly, there are a lot of potentially big-name IPOs this year. If you were to see Anthropic and OpenAI also go public this year, you're potentially talking about $5 trillion of IPOs. What's the most SpaceX has to be the most brand recognizable of those three, right?
I don't know. They're all pretty recognizable at this point.
Yeah.
It's people might not use all of them. I mean, look, none of us use SpaceX really. I guess the Starlink users you could say do, but none of us are riding in the rockets or anything like that.
I saw one of their rockets launch once. That was pretty cool.
Did you?
Yeah.
Oh, I got to tell you, rocket launches are amazing.
It was a funny event because none of us knew that it was happening, and we were pretty far away from it, and all of a sudden just saw this light streaking across the sky from very low, and thought we all might be, on the verge of dying or something like that, but we were.
But you lived.
Yeah. Turned out we just looked it up and said, oh, yeah, there's a SpaceX launch this evening.
It's good. So I think, look, here's the thing about SpaceX, and when we get all of the numbers in the next week or two, we're going to look at them and say, wow, that valuation is crazy. It doesn't make any sense, blah, blah, blah. We know this. We're not going to be, we're not going to wake up next week and say, hey, this is a, $2 trillion company that's doing $1 trillion in revenue.
What a value stock. Yeah. No.
So let's save the chatter about, oh, this is valued too steeply, blah, 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 because quite honestly, there's another Elon Musk company with the name Tesla that's been crazily valued for the last decade or so, and it still is. And despite the fact that Tesla pretty much isn't growing anymore, it hasn't changed anything for the company. I mean, Tesla's revenue has been right around $100 billion a year for the last 3 years right now. It's still valued at $1.6 trillion today.
Right.
It hasn't been an impediment because there is this Elon Musk premium for his companies. It does represent, I think, you can make a case for both of these, probably the greatest key man risk in history. Unlike, let me ask you this, Mike, because we're going through a transition at Apple right now where Tim Cook is stepping down, and what's the name of the guy taking over? John something?
Abel.
No, that's
Jane.
Berkshire.
Oh, sorry, you're right. No, I don't remember.
It's John
Turnus.
Thank you.
You're welcome.
Has Apple stock moved at all as a result of this?
Not really.
No, because people look at Tim Cook, and yes, he's a good operator. We understand that. But the Apple ecosystem exists not because of a Tim Cook, premium. You can make a case maybe there was a Steve Jobs premium back in the day, but Tim Cook proved, okay, you don't really need that.
Yep.
Ultimately, what you are paying for when you buy Apple stock is the fact that they're the rare hardware manufacturer that still maintains 40% margins.
Mm-hmm.
That's the deal. With Tesla, if Elon Musk got hit by a falling piece of SpaceX rocket tomorrow and no longer could be the CEO, what happens to Tesla stock?
I don't know. Yeah, it is a fascinating argument to make because he is just he is the type of person who will not relinquish that type of control the way that other CEOs have chosen to do so. And look, we have plenty of history here of CEOs that attempted to relinquish control and are incapable of doing it, and their stocks suffered. But none
Bob
of them.
Iger.
Yeah, Iger.
Who's the
Starbucks
Starbucks guy?
CEO,
Howard
Schultz. Yeah, I mean, plenty of history there of CEOs that are bad at relinquishing control and then, fight with the newly chosen CEO and end up back in the position. But none of it is so integral to the stock price as arguably Tesla.
Yeah, there's nothing else that's even close.
I mean, heck, even clearly my mind was on Berkshire Hathaway earlier. Yeah, had the most famous investor in the world retire, who had been leading the company for half a century, and yeah, crickets, nothing.
We will need to see how things go there.
Agreed. But there wasn't an immediate sell-off.
No, but part of it's because these companies are not valued crazily. You look at Berkshire Hathaway just as an example. Berkshire's a tough example because it's a financial company, so the metrics are all nutty. But let's take a look at Apple just as an example. And Apple, even if you wanted to believe that there is a Tim Cook premium, okay, so that's good for a forward PE ratio of 34, which again is steep. But remember, Apple's basically been valued this way for a while now. That's a market feature, not it's not an Apple feature that companies like this are getting these kinds of multiples. Apple's basically been in the 30s for the last 6 years, ever since the pandemic. So I think that you look at Tesla on the other hand, and you say, this is a company that's valued 16 times sales, not earnings, but sales. It's valued 208 times forward earnings and 389 times, trailing earnings. What gives? If Elon Musk is not running that company, how do you command that multiple?
Right.
You don't, quite honestly. Yeah. You won't. But again, I'm saying this because the fact that SpaceX is going to have this crazy valuation doesn't mean it's good or bad. Sometimes, Elon Musk companies can carry these crazy valuations for a long time without running into problems. They also might eventually run into issues if the business, fundamentally is unprofitable and they can't make it work. But that's a separate issue from, hey, this company's profitable but just has a crazy valuation. Well, okay, if you want to put your money where your mouth is, then you can bet against either of these in the market.
Yeah, I mean,
have at it.
To your point, there's a reason that X hasn't been a miraculous turnaround story and gone public. Won't occur with every one of them.
Well, is X technically going to be in SpaceX? Because XAI was X part of XAI now?
Oh, is Twitter/X part of space? We'll find out in the prospectus.
I can't even remember how many different machinations have moved things around there on that side.
So you know what? Based on reports from earlier this year, I'm seeing some indication. I would say let's wait on the prospectus because it's not entirely clear. But yeah, there's been mention of lumping it into this thing.
Let's take a quick break. We got hour 2 coming up in just a little bit, so make sure you stick around. A whole bunch of good stuff next.
Cardiovascular disease is the #1 killer of women,
taking the lives of 1 in 3.
That's more than all forms of cancer combined.
For too long, heart disease and stroke have taken the lives of the women we love.
But we're not giving up because we have something better,
stronger, more powerful.
We have each other.
When we come together and go red,
the more power we have against our greatest health threat.
Visit goredforwomen.org today to learn more.
Sometimes we know what's next. Other times, it's impossible to know. Life can change in an instant. Don't be caught standing by the next time someone's heart stops. Knowing CPR gives you the ability to act and takes you from bystander to lifesaver. CPR is a life-saving skill. Join the nation of lifesavers today by learning CPR at heart.org/nation. National support for CPR education provided by Elevance Health Foundation.
This is Tucker Silva of the Financial Exchange Show, and I'm joined today by estate planning attorney Todd Lutzke with your Financial Exchange Quick Tip of the Day. And today we're talking about the top estate planning mistakes to avoid. Todd, what is the downside of adding your kids to your accounts or adding their names to your real estate deeds as a joint owner? Won't this avoid probate?
You're absolutely right. It would avoid probate, but there are better ways to avoid probate than just doing something simple, right? Simple isn't always better. Throwing a name on an account or adding a designated beneficiary or a joint owner on a piece of property might not be the best way to go. Here's the problem. If you name one of your children as a joint owner and you have 3 children and you put that child on just because it's convenient and they're geographically close to you, well, you could be accidentally disinheriting your other children because this property, this asset will only go to that child. That child doesn't have to give it to the other kids. So that's a problem. And if you put your name, if you add a child's name to your real estate, now you're exposing it to that child's creditors, that child's potential divorces. That's never good. And plus, you've lost control over it. If you try to sell it, you need that kid's permission, and half the money would go to that kid. Please, folks, set up a trust, fund your trust much better than just trying to do it shorthanded and just give away assets or adding names to accounts.
Todd Lutzke and the estate planning experts at Cushing & Dolan have written a brand new guide that details the estate planning blunders to avoid. You can request this brand new guide by calling 866-848-5699. That's 866-848-5699, or you can request it from their website, legalexchangeshow.com.
The proceeding was paid for, and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing and Armstrong do not endorse each other and are not affiliated. This is the Money Matters Radio Network, WBNW 1120 AM and W275 CM FM. Concord, Boston, the Money Matters Radio Network.
For many hardworking families and retirees, an energy bill comes with an impossible choice. Paying the bills, putting food on your table, and keeping your family warm in winter and your home cool for the summer. But it shouldn't be that way. For more than 40 years, Citizens Energy has made one simple promise: to help households afford life's basic needs. Through Joe for Oil, we help neighbors through the coldest winter nights. Now, we're building on that same promise with Joe for Sun, a new way to save on electricity year-round. Our solar projects are already in communities across Massachusetts and New York, helping thousands of households save money. For many families, that means saving up to 50% on electricity. No installation, no equipment, and you keep your utility company. Like my dad's program before, we keep it simple, helping lower your utility bill through community solar at no cost to you. Call 1-855-JOE-FOR-SUN or visit citizensenergy.com to see if you qualify. You've trusted Citizens Energy to show up when it matters most. We're still here, ready to help.
Sponsored by Citizens Energy.
Environmental nonprofit Ocean River Institute is working with communities to tackle climate change with nature-based solutions that feature slowing water down and building more soil with grasses and plants. Research indicates that people acting in their own neighborhoods can build an inch of soil in a year and slow sea level rise down by as much as 25%. Please visit oceanriver.org for more information on opportunities to make a difference and go the distance for savvy stewardship of a greener and bluer planet Earth.
Let's talk LDL. AKA bad cholesterol. The higher your LDL cholesterol, the higher your risk of a heart attack or stroke. Your health matters. Know your number. Talk to your doctor and get your cholesterol checked. And learn how to help lower your LDL bad cholesterol. Because your health is in your hands. Find out more at heart.org/LDL.
Our Senators Edward Markey and Elizabeth Warren and Representative James McGovern are standing up for radio listeners like us by supporting legislation to keep AM radio in cars. They know the value of local radio in times of emergency. Now it's time for Congress to finish the job and pass the AM Radio for Every Vehicle Act. Learn more at dependonam.com. This message furnished by the National Association of Broadcasters and this station.
This is Michael Valila, adjutant of the Disabled American Veterans Department of Massachusetts. The DAV of Massachusetts has helped me and countless others adjust to civilian life through a variety of incredible programs. Through our local Veterans Assistance Program, we provide necessary services to veterans and their communities, such as food shopping, landscaping, and companionship, but we need your support. You can help by making a donation today. Please visit dav5k.boston. That's dav5k.boston.
Hi, this is Chuck and Mike from the Armstrong Advisory Group, and we have a guide this month titled Consolidating Investment Accounts. Mike, what are some of the problems that people run into when they have accounts scattered everywhere?
The first one is just difficult to maintain and monitor. I can't tell you how many times I've met with somebody who has a life insurance policy that still has their brother on it instead of their wife or their husband, for example. So it does become really tough to monitor those things. If you're getting to required minimum distribution age, there can be certain rules around where you take money out of specific accounts, and if you miss it, there can be tax penalties. So it just becomes complicated to administer everything.
Despite that, there are still some cases where it makes sense to maintain a number of separate accounts as opposed to consolidating.
Oh, absolutely. I mean, we all know cases where, hey, that new bank is going to give you a better CD rate or introductory rate, and that can be worth real money. In other cases, you know, if you have a retirement plan, there can be special benefits to keeping the money there. Maybe it is a excellent plan with really low costs. Maybe it'll allow you to avoid a required minimum distribution if you're still working into your 70s. Or there can be other strategies too, you know, having money in a retirement plan and allowing you to do what's called a backdoor Roth conversion, all sorts of things that allow you to take advantage of having accounts in specific places.
Folks, the guide is titled Consolidating Investment Accounts, and there are two ways to request it. The first is by calling 800-393-4001. The second, by going to armstrongadvisory.com. That number again is 800-393-4001, or request it online at armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services. The Financial Exchange is produced by Money Matters Radio and is hosted by employees of the Armstrong Advisory Group, a registered investment advisor. All opinions expressed are solely those of the hosts, do not reflect the opinions of Armstrong Advisory or anyone else. Investments can lose money. This program does not offer any specific financial or investment advice. Please consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong Advisory and the advertisers heard on this program do not endorse each other or their services. Armstrong and Money Matters Radio do not compensate each other for referrals and are not affiliated. This is the Financial Exchange with Chuck Zodda and Mike Armstrong. Your exclusive look at business and financial news affecting your day, your city, your world. Stay informed and up to date about economic and market trends, plus breaking business news every day. The Financial Exchange is a proud partner of the Disabled American Veterans Department of Massachusetts. Help us support our great American heroes by visiting dav5k.boston and making a donation today. This is the Financial Exchange with Chuck Zodda and Mike Armstrong.
Chuck, Mike, and Tucker with you.
Hello.
Well, it was Chuck, Mike, and Tucker. Now it's just Mike and Tucker for a nice little intimate conversation here. But welcome back to the Financial Exchange. We've got markets pretty heavily in negative territory after a big rally day yesterday on excitement about the AI sector, a Cerebras IPO that went off pretty with a high degree of fanfare. And so today, a little bit of retrenching here in markets. We've got the NASDAQ off right now, 376 points, or about 1.4%. Russell 2000 off 64 points, 2.25%. That's your small and mid-sized companies. The S&P 500 off 1%, and the Dow Jones Industrial Average off 0.9%. In oil markets, we are well above, again, that $100 a barrel benchmark, sitting at $104.50 per barrel. That's up 3.5%. 3.33% today, and we've been keeping an eye on that 10-year Treasury yield, which is jumping pretty significantly now. The 30-year actually topped 5.1%. That's the highest in about a year. The 10-year Treasury now up to 4.58% on that 10-year yield. Taking a look around at other prices that folks tend to keep an eye on. National average for a gallon of gasoline now, according to AAA, sitting at $4.53 per gallon. I'm rounding slightly, and keeping an eye on California because they are the worst case scenario for this type of environment. $6.14 a gallon out there, and those mortgage rates continue to be stuck in that 6.5% range and climbing. We're now at 6.52% on the 30-year fixed rate, and given today's interest rate moves, I suspect that will move a bit higher. Chuck, anything else catching your eye in markets this morning?
I do think that the rates discussion is one worth having now, just because this move that you are seeing across the yield curve is notable and fairly rapid here. I mean, when you've got a 12 basis point move on the 10-year in a single day, like that makes my ears perk up a little bit and say, okay, like this is worth paying attention to. And the other piece on this is, you take a look at, shorter term rates markets and what we're seeing in like Fed funds futures markets and things like that. You're now starting to see potentially a hiking cycle that is getting priced into the early part of next year now. We talked just yesterday that, look, there's still nothing really being priced in until the latter part of next year. You're now up to the March 27 meeting, so fewer than 12 months out from now, with a 70% chance of a hike occurring by then. So I think that rates markets are starting to pick up on the fact that the inflation problem that is present is unlikely to be fully solved in short order. And by the way, even the data that we were getting before the Iran conflict began, that data was suggesting potentially a little bit of a pickup in inflation. And even Jay Powell had noted this with, hey, you've got this CapEx cycle that's going on relating to these AI data centers that are being built out. And there is some inflation that was starting to show up as a result of that. This is something that I do think is worth watching because, again, first of all, as we said yesterday, look, the Fed generally does not like to do like one and done in either direction. So the concern for bonds is not, hey, does the Fed, hike once? Because there's no meaningful difference between a Fed funds rate at 3.5 and 3 3/4. There is a meaningful difference between a Fed funds rate at 3.5 and a Fed funds rate at 5. And the market might be starting to sniff out that that's the direction that things need to go in because of inflationary pressures that are building here.
Right. Other items just to keep an eye on. We've been talking at length about that IPO from yesterday of the little-known company Cerebras, ticker symbol CBRS, off pretty substantially today. Again, this is its second day as a public company, but when it started trading yesterday, it ticked to $385 per share. It looks like the first price at 1 p.m. It's now sitting at about $296 per share. Still well above the IPO price in the hundreds per share. Let's actually, Chuck, if you don't mind, let's take a quick break. We're going to be joined during the next segment by Lawrence Ball. He's a professor at Johns Hopkins University, professor of economics, consults all over the world with central banks and elsewhere, and we've been talking about that interest rate story and inflation. Professor Lawrence Ball from Johns Hopkins joins us next on the Financial Exchange.
Market insight, retirement strategies, real talk about Wall Street and economic trends. All live every day on our YouTube channel. Go to youtube.com/The Financial Exchange Show. This is The Financial Exchange.
Hi, this is Chuck from the Armstrong Advisory Group. If your financial life feels scattered, you're not alone. Over time, it's easy to end up with accounts in different places. Old retirement plans, different banks, multiple apps. It's what we call account sprawl. When you've got your money across the spectrum, things can get missed, like overlapping investments, and bringing everything into focus allows you to spend less time tracking accounts and more time making smart decisions. Our new guide is called Consolidating Investment Accounts, and it may offer strategies that can simplify simplify your overall financial picture. Call 800-393-4001 to get your free copy today. That's 800-393-4001, or you can request the guide at armstrongadvisory.com. That's armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services. Long-term care costs can reach thousands of dollars per month and can put a serious strain on your savings. The experts at Cushing & Dolan often see families caught off guard by that reality. Without the right plan in place, those costs can quickly eat through a lifetime of your hard work. But here's the shocker. Many estate plans don't protect your assets from those expenses. The right strategy may involve specific types of trusts designed to help protect your assets, but timing matters. Cushing & Dolan has a brand new guide called Detour Ahead, Estate Planning Potholes to Avoid. It breaks down some of the most common and costly mistakes people make and explains how to help protect your assets, your family, and your future. Call 866-848-5699 to get your free copy today. That's 866-848-5699. Or you can request the guide online at LegalExchangeShow.com. The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and/or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated.
Our Senators Edward Markey and Elizabeth Warren and Representative Jake Auchincloss are standing up for radio listeners like us by supporting legislation to keep AM radio in cars. They know the value of local radio in times of emergency. Now it's time for Congress to finish the job and pass the AM Radio for Every Vehicle Act. Learn more at dependonam.com. This message furnished by the National Association of Broadcasters and this station.
As a busy mom to 4 kids, my to-do list is full.
Trying to fit in exercise, eating right, and prioritizing self-care can feel next to impossible.
While we can't add more hours to the day, we do have a great resource to help.
Go Red for Women has easy tips, tools, and information to help you and your family live a healthier life.
So to all the moms, the aunts, grandmothers, and amazing women out there doing it all,
visit goredforwomen.org/momlife today.
You take care of them, Go Red for Women will take care of you.
In a heartbeat, you could be the difference.
Mark collapsed from cardiac arrest.
9 out of 10 people who suffer cardiac arrest outside the hospital don't survive.
It took 30 minutes of chest compressions to finally feel a pulse.
Most of the time, it's because no one nearby performs CPR. But together, we can change that. Extraordinary things happen when people take action. A small step, a simple skill, a life-saving moment. Heart Walk brings communities together to create health and hope for every heartbeat. Every walker who joins Heart Walk, every dollar donated, means more people trained in CPR, more research, and more life-saving moments for everyone. Take the first step and register for your local Heart Walk. Extraordinary starts with you. Join Heart Walk today. Find your local Heart Walk at heartwalk.org.
Markets move fast. Follow the Financial Exchange live on X so you never miss a story. This is the Financial Exchange Radio Network.
Joining us now is Professor Lawrence Ball. He's professor of economics at Johns Hopkins University. He's also a research associate at the National Bureau of Economic Research, experience with the IMF, and also was a visiting scholar at a number of central banks, including the Federal Reserve. And so, as you can probably tell from his resume, immensely more qualified to talk about the state of the economy today than I am. And he's joining us now. So, Professor, thank you so much for taking the time. We appreciate it.
Happy to be here.
So, look, over the course of the last year or so, I've heard comparisons of the economy today to the 1970s and the oil price shocks. I've heard comparisons to the dot-com bubble regarding the AI fascination that we're seeing. And I've even heard comparisons to 2008 because out of concerns for the private credit sector and what's happening in that space. When you look at the price shocks of the 2020s that we've experienced so far, COVID, tariffs, now war in Iran, how do you look at that moment and compare it to the 1970s, or is that not the right comparison to be making for this moment in time?
I think for inflation, that is not the right comparison.
Okay.
I think the big difference is in the 1970s, inflation was wandering around and expectations were following actual inflation. So when Paul Volcker wanted to reduce inflation, he was doing that in the face of high expected inflation. And that in that situation, you have to really bash the economy on the head to reduce inflation. Whereas in this century, long-term inflation expectations seem to have been well anchored. And we, of course, had a big spurt in actual inflation in 2021, 2022. But the fact that long-term expectations stayed low meant that there was a natural tendency for inflation to come back down after the underlying shocks worked their way through and we didn't need a big recession. And I think that's probably the most likely scenario for the recent uptick in inflation due to oil prices.
Okay, so you did speak to expectations there, and I think we all remember Jay Powell and the Fed using that word transitory to describe the 2021-2022 time period, and I think very clearly there were some different expectations of the definition of transitory, but ultimately, to your point, that COVID-era inflation did dissipate, and this moment may too. What do you read into consumer expectations for inflation now? Because they are elevated compared to a few years ago, but are they not elevated to the point that you find it problematic?
Yeah, it's funny, the transitory issue, people talk now about long transitory, which is kind of an oxymoron. But anyway, so there is a debate among economists about which expectations are important.
Okay.
Short-term expectations of consumers or longer-term expectations. Long story short, I'm on the side of thinking what's really important is long-term expectations, that price and wage increases are based on norms that have to do more with the long-term trend in prices than with what's happening right now or in the coming year. I mean, other people dispute that, but that's my view. And long-term expectations have been, stayed quite anchored. And so, despite short-term consumer expectations moving around, that gives me reasonable optimism that inflation is not going to take off persistently.
You've got experience, obviously, having consulted or visited many other central banks, and we tend to be very U.S. focused on this program, and me in particular, very more familiar with the U.S. Federal Reserve than, say, the Bank of Japan. But many have argued that Fed independence is more fragile today than it has been in some time, and I wonder, in your mind, having experience consulting or visiting other central banks where that issue of independence may or may not be such a central focus, how do you view the threat to independence, and will the new incoming chair face some degree of credibility issues given all of that, or is it politics and we're making too much of it at the moment?
No, we're not making too much of it. Certainly there are threats to independence. I mean, President Trump's assault on the Federal Reserve as independence and, attempts to indict people and so on and so forth are really unprecedented. I mean, I could go on and on about how outrageous that is. I don't think that Kevin Warsh is at all the main problem. Mm-hmm. It's pressure from the president. I mean, having said that, and again, I certainly don't want to cast any negative judgments on Kevin Warsh, but I think it's reasonable to maybe wonder a little more about his credibility or independence than, say, we did about Jay Powell or Janet Yellen or Ben Bernanke. I mean, I think it's on the record that for much of his career, he was, tended to favor higher interest rates. More recently, more favoring lower interest rates. He has logical economic arguments for that, but it's not crazy to wonder whether politics plays some role in it. So I don't think he should be prejudged, but I think people will be watching. And I think, by the way, he has a very tough job. Again, from what I know, I think he's a very smart, well-informed person who wants to basically be responsible, which means not reducing the federal funds rate to 1% very quickly. So I think there's a good chance he will disappoint the president And it could be pretty soon when we start seeing on Truth Social, things about, worthless Warsh is doing it again.
Ooh.
And it'll be interesting to see how he handles that political problem.
As we look through the next several months of inflation, obviously the waters are going to be muddied because of the energy shortages that we're seeing in other parts of the world, the higher prices that we're seeing here domestically. When you look at that sort of data, how do you try and sort through the noise to find the actual reality on the ground? What are you looking at in terms of the inflation data now to kind of get an indication for what we might be worried about in the future? And again, what matters, of course, is the longer term and how that influences expectations of inflation.
So, I could briefly answer at two levels, kind of at a technical level.
Sure.
I'm a big fan of the median inflation rate that the Cleveland Fed produces, which is a way of filtering out big shocks to certain sectors and measuring the underlying trend. And that is still pretty subdued.
Okay.
But, more broadly, I think, obviously, there's this big energy price shock. I think the most likely scenario for how that plays out is the same way as in other energy price shocks this century, which there have been several, which is that we get a big jump in headline inflation. But again, risky to use this word, that's transitory, inflation comes back, underlying inflation is stable, headline inflation comes back down. It's painful for people who buy gasoline. It has economic costs, but the Fed maybe can more or less look through it or ignore it. So in that sense, probably doesn't have big implications for monetary policy. Of course, who knows? Nobody has any idea what will happen with the war. You can imagine, things get worse. There's some huge cutoff of oil supplies, but I think the most likely scenario is not that disastrous.
Professor, this has been a real pleasure. We really appreciate you joining us and getting your take on this moment in time right now, which, the world has been changing fast over the last year or so, and keeping things grounded is much appreciated. It's Professor Lawrence Ball. He's Professor of Economics, Director of Graduate Studies at the Johns Hopkins University, and joined us today to talk about the state of inflation, interest rates, and the Fed. Thanks so much for joining us, Professor.
Thank you.
All right, time for trivia here on the Financial Exchange. And on this day in 1856, L. Frank Baum was born. Baum is famous for writing The Wizard of Oz and its numerous sequels. So our trivia question today, how many sequels to The Wizard of Oz did L. Frank Baum write? Once again, how many sequels to The Wizard of Oz did L. Frank Baum write? Be the fifth person to text us at 617-362-1385 with the correct answer, along with the keyword trivia. You'd win a Financial Exchange Show t-shirt. Once again, the fifth correct response to text us to the number 617-362-1385 with the correct answer, along with the keyword trivia, will win that t-shirt. See complete contest rules at financialexchangeshow.com.
Got to be honest, Mike, didn't even know that The Wizard of Oz had sequels.
Well, maybe it doesn't. Maybe the answer is none.
Stay tuned.
Guess we'll find out.
That would be a tricky one,
yeah.
But who knows? Mike, let's talk about this piece from NPR. Gen Z homeowners are on the rise despite, some potential headwinds out there. Gen Z are saying, yeah, we're going to try to make a run of homeownership.
No kidding. This does remind me a bit of the millennial story where, how much was written post-GFC, Great Financial Crisis, about the millennials and how they would never be able to afford their homes. And then they ended up being a little bit delayed. They didn't end up buying homes until later in life. But by the time you got to age 35, their rate of homeownership was the exact same as the baby boomers. We don't know about Gen X because everybody forgets about Gen X. But the exact same rate. And so, look, the situation on the ground for Gen Z is going to be difficult, more complicated, higher interest rate than what the millennials were facing, but they have a better job market than what millennials were facing. And frankly, based on most indications I'm seeing, the housing market is flipping towards more of a buyer's market than it has been for any time in the last 5 years. And so I suspect that Gen Z and their home ownership will follow the same track as other generations. It'll be a little bit different because of different circumstances on the ground. But anybody that's been trying to sell you on how Gen Z is never going to buy homes and they just want to rent permanently is the exact same story that I heard about millennials, and it's just fundamentally probably untrue.
Yeah, I in general think it's not worth judging a generation's ease of financial stress. It's not worth judging their level of, financial stress or financial hardship until they're like, I would say 75 to 80.
Yeah, that's fair. You need a bigger look into what actually occurred during their lifetime to drive them to the point where they are.
Yeah,
So,
the only generation that we can judge immediately is, what's the one after Gen Z? Is it Gen Alpha? Is that what we're calling it?
I don't know. Is that my kids? Probably.
I have very high hopes for that generation because my hope is effectively that all the bad stuff about technology will have worked out by the time they're coming of age, and they won't have to deal with that.
Yeah, that seems totally likely, Chuck. Glad to hear it.
I think so. Let's take a quick break here. We've got the trivia answer next.
Bringing the latest financial news straight to your radio every day. It's the Financial Exchange on the Financial Exchange Radio Network.
Our Senators Edward Markey and Elizabeth Warren and Representative Stephen Lynch are standing up for radio listeners like us by supporting legislation to keep AM radio in cars. They know the value of local radio in times of emergency. Now it's time for Congress to finish the job and pass the AM Radio for Every Vehicle Act. Learn more at dependonam.com. This message furnished by the National Association of Broadcasters and this station.
In Massachusetts, summer starts at the farmer's market. Longer days, fuller tables, and the best local food coming in fresh each week. Find just packed produce, responsibly raised meats, small batch cheeses, fresh caught seafood, and thoughtfully made goods. It's where neighborhoods come together and local food shines. Stop by your market this season and support farmers and makers across the state. Sponsored by Mass Farmers Markets. Growing farmers markets across Massachusetts. Find your local market at massfarmersmarkets.org.
Long-term care costs can reach thousands of dollars per month and can put a serious strain on your savings. The experts at Cushing & Dolan often see families caught off guard by that reality. Without the right plan in place, those costs can quickly eat through a lifetime of your hard work. But here's the shocker. Many estate plans don't protect your assets from those expenses. The right strategy may involve specific types of trusts designed to help protect your assets, but timing matters. Cushing & Dolan has a brand new guide called Detour Ahead, Estate Planning Potholes to Avoid. It breaks down some of the most common and costly mistakes people make and explains how to help protect your assets, your family, and your future. Call 866-848-5699 to get your free copy today. That's 866-848-5699. Or you can request the guide online at LegalExchangeShow.com. The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and/or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated.
For many hardworking families and retirees, an energy bill comes with an impossible choice. Paying the bills, putting food on your table, and keeping your family warm in winter and your home cool for the summer. But it shouldn't be that way. For more than 40 years, Citizens Energy has made one simple promise: to help households afford life's basic needs. Through Joe for Oil, we help neighbors through the coldest winter nights. Now, we're building on that same promise with Joe for Sun, a new way to save on electricity year-round. Our solar projects are already in communities across Massachusetts and New York, helping thousands of households save money. For many families, that means saving up to 50% on electricity. No installation, no equipment, and you keep your utility company. Like my dad's program before, we keep it simple, helping lower your utility bill through community solar at no cost to you. Call 1-855-JOE-FOR-SUN or visit citizensenergy.com to see if you qualify. You've trusted Citizens Energy to show up when it matters most. We're still here, ready to help.
Sponsored by Citizens Energy.
This is Tucker Silva of the Financial Exchange Show, and I'm joined today by estate planning attorney Todd Lutzke with your Financial Exchange Quick Tip of the Day. And today we're talking about the top estate planning mistakes to avoid. Todd, what is the downside of adding your kids to your accounts or adding their names to your real estate deeds as a joint owner? Won't this avoid probate?
You're absolutely right. It would avoid probate, but there are better ways to avoid probate than just doing something simple, right? Simple isn't always better. Throwing a name on an account or adding a designated beneficiary or a joint owner on a piece of property might not be the best way to go. Here's the problem. If you name one of your children as a joint owner and you have 3 children and you put that child on just because it's convenient and they're geographically close to you, well, you could be accidentally disinheriting your other children because this property, this asset will only go to that child. That child doesn't have to give it to the other kids. So that's a problem. And if you put your name, if you add a child's name to your real estate, now you're exposing it to that child's creditors, that child's potential divorces. That's never good. And plus, you've lost control over it. If you try to sell it, you need that kid's permission, and half the money would go to that kid. Please, folks, set up a trust, fund your trust much better than just trying to do it shorthanded and just give away assets or adding names to accounts.
Todd Lutzke and the estate planning experts at Cushing & Dolan have written a brand new guide that details the estate planning blunders to avoid. You can request this brand new guide by calling 866-848-5699. That's 866-848-5699, or you can request it from their website, legalexchangeshow.com.
The proceeding was paid for, and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing and Armstrong do not endorse each other and are not affiliated. Time now for Wall Street Watch, tracking the stocks, the data, and the headlines driving markets so far today, right here on the Financial Exchange Radio Network.
Markets selling off by midday as Wall Street hits the brakes on the recent tech rally, with several chip makers, including NVIDIA, AMD, and Intel, seeing losses on the day. Sentiment is also lower after the summit between President Trump and Chinese President Xi yielded no major policy developments. Right now, the Dow is down over 0.8%, S&P 500 down 0.9%, or 66 points lower, NASDAQ down over 1%, or 307 points, Russell 2000 selling off 2.3%. 10-year Treasury yield is up 12 basis points at 4.581%, and oil up 3.5%, trading right around $104 a barrel. After its NASDAQ debut yesterday, shares in chipmaker Cerebras down by 2% today. Yesterday, the stock surged 68% to close at $311 a share after it opened at $185 a share in its IPO. Meanwhile, shares in Applied Materials are down nearly 1%, despite the semiconductor equipment maker beating second quarter expectations on the top and bottom lines. The company also said it expects stronger sales this year than it previously forecasted, as it continues to see strong demand for AI computing. And Starbucks announced another round of corporate layoffs this morning, about 300 in the U.S. This marks the coffee chain's third round of layoffs since CEO Brian Niccol took over. Starbucks shares are up by about 0.5%. I'm Tucker Silva, and that is Wall Street Watch. On the previous segment, we asked you the trivia question: how many sequels to The Wizard of Oz did L. Frank Baum write? Well, that would be 13. And Casey from Derry, New Hampshire is our winner today, taking home a Financial Exchange Show t-shirt. Congrats to Casey. And we play trivia every day here on the Financial Exchange. See complete contest rules at financialexchangeshow.com.
The mail's here. Here's the mail that never fails. It makes me want to wag my tail. When it comes, I want a whale mail.
You've got questions, we've got answers. It's time for the Money Matters Mailbag. We're tackling your calls and emails on everything from economic policy to global markets and everything in between. Leave us a voicemail at 339-399-4333 and you might hear it on the show. You can also email your question to tfeshow@gmail.com. Now, it's time for the Money Matters Mailbag.
Thank you, big voice guy. And yes, it is time for the Money Matters Mailbag. And again, if you have any questions for Chuck and Mike, all you have to do is email us, tfeshow@gmail.com. That's tfeshow@gmail.com, or you can leave us a voicemail to the number 339-399-4333. All right, gentlemen, let's get started here with our first question. This listener says, I'm only 34 and just started saving for retirement, feeling behind and so dumb about how I've spent. I haven't formulated a plan just yet with hard numbers, but am contributing to my SEP IRA here and there. There's hope, right?
No, all hope is lost. Give up now and blow it all at the casino. Yeah, look, I mean, the best time to start saving for the future is yesterday. And so today is better than tomorrow, and likewise. Interesting point here about the SEP IRA. So clearly you've done a little bit of research. That means that you must have some self-employment income, because that's what that SEP stands for those unfamiliar with it. And it's a way for those who are working in the gig economy or might own their own business to be able to fund a retirement account with higher limits than your traditional IRA. That's likely why this person's looking at the SEP. I think, other things to be asking yourself as you're trying to formulate this overall plan. Hey, would I be served better by a Roth IRA, or would that be a good supplement to it? And I think the other word of caution here would just be that when I've seen people fall behind on retirement savings, they get super focused on it, which is great. But just, be sure that you don't put yourself in a dangerous financial position by falling too far down the retirement contributions range. Like, it can be too much of a good thing, and I've seen people fall behind on tax payments for, you're clearly a self-employed. So, hey, am I paying all the taxes that I owe, or did I put some of my tax money into my IRA, and can I make that tax payment now? Or I thought I was doing what I should to fund retirement, but then a piece of my equipment went down, and suddenly I can't operate my business in the same way because I overfunded my retirement. So there's a lot that goes into that. Obviously, the next step is, like you said, putting together a plan and getting some numbers there. But no, it's never too late. And, clearly you've educated yourself on some of the kind of extra, more nuanced tools that are out there, like a SEP IRA. Chuck, anything to add on that?
No, I think you hit the big items, and I've got nothing else to add.
All right, on to the next question to the Money Matters mailbag. I have several 401k accounts from separate employers. What are my best options? Would it be better to move them all into a single rollover IRA account?
So, Mike, you mind if I take this one?
Please.
It's a good question. And the answer is not entirely straightforward, because there are some considerations that you need to pay attention to. The first is, okay, number one, if you have a plan at an active employer, generally you're not going to be allowed to roll that in most cases. There are some situations where you could, but that plan generally needs to stay there. Beyond that, some plans might have, beneficial investments in terms of, low-cost investment options that are not available to individual investors, but that are available through a plan with, large, total investment amounts. And so you might have cheaper investment options within that plan that you don't have access to elsewhere. Certain plans may also offer you additional services. You might be able to get reduced fee financial planning through them, or other services that can assist you with your overall finances. And so it may be worth keeping those open in order to continue to have access to those services and or investments. In a lot of cases, what you do see is that, hey, if none of those features are present and you kind of do all of your due diligence, if you're simply looking to consolidate funds, yeah, it can make sense in some situations to consolidate into either a rollover IRA or potentially into a current employer 401k plan. But you got to do the due diligence on each one of these, because it's not always a slam dunk when you look at things such as costs and services offered by each particular plan. Certainly, having fewer accounts means less stuff that you have to keep track of, but you do want to make sure you're not giving anything up in conducting a rollover there that you're not, aware of. Any thoughts on your end, Mike?
Just a couple other items to add on rare instances. One, if any of those 401ks have company stock in them, pause, talk to an expert, because that's a really complex matter that you need to figure out. Two would be if you are rolling them into that 401k as opposed to a rollover IRA, it can make you eligible to maybe do what's referred to as a backdoor Roth IRA contribution. That may or may not be necessary in your case, but you can only do it if all of your assets are in a employer-sponsored retirement plan rather than an IRA. So, another important consideration when you're talking about consolidation there.
On to the final question this week for the Money Matters mailbag. Where did it go? Here it is. Are there downsides with opening a tax-advantaged investment account with your employer? What about opening one by yourself?
I'll start this one off. So, the obvious downside to opening one by yourself is that there are far lower contribution limits compared to a traditional employer-sponsored plan. Sure. And you're going to miss out on matching contributions if your employer offers them. So, that's a pretty big downside. Yeah. The main downside that I can think of with opening with an employer is that each one of these are different. And there's no way for you and I, Chuck, to sit here and say, oh, you've got a great plan with really good investment options and low costs, or you've got a plan that's hot garbage that's going to tie up your money for over a decade because they place it in annuities. We literally can't know because we don't know enough about your specific situation. But just be aware that both of those do exist. I have run into, for some reason, in my experience, it's always teachers that are offered just the most ludicrous retirement plan lineups with all sorts of complex offerings in them. Sure. But there are others where it's really compelling, really low cost. A lot of services attached to it. And so, can there be downsides? Yes. There can also be downsides by going with the, self-directed IRA on your own. So, do a little bit of research, understand what you're getting before you go do it.
All right. So, once again, if you have questions for our weekly segment, the Money Matters mailbag, we do it at this time every week. So shoot us an email if you have questions for Chuck or Mike to tfeshow@gmail.com. That's tfeshow@gmail.com, or leave us a voicemail, 339-399-4333.
Let's take a quick break. When we come back, Paul LaMonica from Barron's joins us next on the Financial Exchange.
From markets to money to business and financial news, watch the Financial Exchange every day on YouTube. Hit that subscribe button and keep up to date on the market news you need to know. This is the Financial Exchange. It's important to update your estate plan as changes occur in your life, or you can wind up with significant issues that may affect your future. Get Cushing & Dolan's new guide called Detour Ahead, Estate Planning Potholes to Avoid. Call 866-848-5699 and get your copy today, or request it online at LegalExchangeShow.com. The proceeding was paid for, and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and/or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated.
Hi, I'm Michael Valila, Adjutant of the Disabled American Veterans Department of Massachusetts. The DAV of Massachusetts provides thousands of hours of voluntary services at our VA medical centers and soldiers' homes, and is the only DAV department in the country to lead a veterans housing initiative for both single veterans and those with families. These programs are critical to serving our veterans in their time of need. You can help our great American heroes by making a donation today. Please visit dav5k.boston. That's dav5k.boston.
Hi, this is Mike Armstrong from the Armstrong Advisory Group. One of the biggest challenges in financial planning is seeing the full picture. When your investments are spread across multiple accounts, it can be difficult to know how much you actually have and whether your strategy is really working. You might be taking on more risk than you realize, or missing opportunities to better align your portfolio. Bringing your accounts together can help create clarity so you can see your total assets, your true allocation, and make more informed decisions about your financial future. Our new guide is called Consolidating Investment Accounts. It walks you through how to get organized, simplify your strategy, free and build a more complete financial plan. Call 800-393-4001 to get your free copy today. That's 800-393-4001, or you can request the guide by visiting armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services.
Environmental nonprofit Ocean River Institute is working with communities to tackle climate change with nature-based solutions that feature slowing water down and building more soil with grasses and plants. Research indicates that people acting in their own neighborhoods can build an inch of soil in a year and slow sea level rise down by as much as 25%. Please visit oceanriver.org for more information on opportunities to make a difference and go the distance for savvy stewardship of a greener and bluer planet Earth.
For many families, an energy bill can mean difficult choices, wondering when or even how it will get paid. It shouldn't be that way. For more than 40 years, Citizens Energy has helped families afford life's basic needs. First through Joe for Oil, and now through Joe for Sun. A simple way to save on electricity at no cost to you. No installation, no equipment, and you keep your utility company. We keep it simple and help you lower your utility bill. Call 1-855-JOE-FOR-SUN or visit citizensenergy.com to see if you qualify.
Sponsored by Citizens Energy.
It happens all over Massachusetts.
Can you tie my shoes?
In every home and every community.
Be careful on your bike.
Learning can happen anytime, anywhere.
We'll see you at practice this weekend.
And no matter how learning takes place in your family's life, DESE is there as your partner. The Massachusetts Department of Elementary and Secondary Education. Never stop learning. Find out more at mass.gov/back-to-school.
Sponsored by the Massachusetts Department for Elementary and Secondary Education.
When a heart stops, the clock starts. You are the first responder until help arrives. In that moment, 4 minutes equals brain damage. 6 minutes equals too late in an emergency. The first responder is you. We need you. Will you be ready? Learn CPR. Visit heart.org/nation. That's heart.org/nation.
Text us at 617-362-1385 with your comments and questions about today's show, and let us know what you think about the stories we are covering. This is the Financial Exchange Radio Network.
Ladies and gentlemen, the weekend.
As promised, we're now joined by the one, the only Paul LaMonica, here to talk a little bit about what we are seeing in the IPO market. Paul, how you doing today?
Good, thanks. How you guys doing?
Doing well. So we had the much hyped Cerebras IPO yesterday that went off very well. Like basically the polar opposite from the CoreWeave one at this time last year, which really struggled out of the gate before catching fire. And I'm wondering, just your thoughts on where the tech IPO market sits right now and kind of what we're expecting over the rest of the year here.
Yeah, no, it's a great question. It's interesting because before the successful debut, at least for, the first day, Cerebras has pulled back a little bit with the rest of the market. But at last check, it was only down about 3%, which isn't too dramatic given the nearly 70% spike yesterday. The tech IPOs actually hadn't really been a big part of the IPO market so far. It's been more biotech and a lot of the kind of AI enablers in the industrial space. But I think that, Cerebras, because of AI chips and all of the excitement around that, we're seeing how semiconductor stocks have surged. This does bode well potentially for SpaceX, which should be going public sometime in June. Looks like they might be even giving their real filing, advancing beyond the confidential phase. That could be dropping as early as next week, according to reports. So a lot of investors are going to be focused now, I think, once again on tech IPOs, whether or not we get offerings maybe from Databricks, from Stripe, from Canva, design software company. And then, of course, OpenAI and Anthropic are the ones in AI that are looming large as well. They haven't filed yet, but everyone waiting for them to do so.
Is there any sense that there's so much supply coming from all of these tech IPOs that it could impact already public tech stocks?
Yeah, it's a great question. I have spoken to some people who wonder whether or not active managers, active fund managers, as well as retail investors, if they want to make room to own SpaceX and potentially OpenAI and Anthropic, do they have to sell other stocks in order to raise those proceeds? And where do those sales come? Do they come from other tech stocks or other parts of the market? But I think what's going to be really interesting, though, is that you might have, quote unquote, forced demand for some of these stocks if Elon Musk, as we're hearing, is able to convince some of the index providers. Does SpaceX get added to the NASDAQ 100 and S&P 500, given it's going to have a 2 trillion plus valuation, most likely, more quickly than companies like Alphabet, Google, and Facebook, Meta did in the past? They had to wait a while before they were added to the indexes. Looks like SpaceX is probably not going to have to wait nearly as long. And if that's the case, that sets the precedent for OpenAI and Anthropic, even though they probably aren't profitable yet, to be added to these indexes as well. So a lot of funds will be forced to buy these stocks if they're added to major indexes.
Given this scale of these IPOs, I mean, between SpaceX, OpenAI, and Anthropic, we're potentially talking like $4 to $5 trillion in market cap. That's a pretty drastic change to the competition, to the composition of these indices if they end up being added. It's, investors immediately after would not own anywhere close to what they owned previously. It's a pretty big shift.
Yeah, I think, and there are definitely already concerns about market concentration in tech AI, and that will only be magnified. I mean, we've got the Magnificent Seven, of course. That doesn't even include Broadcom, which is, got a market cap now that's bigger than some of the Mag 7 companies. So throw them in there for an elite eight, if you will. And then you potentially have SpaceX, OpenAI, and Anthropic added to the SP 500. That's what, an awesome 11 or something like that, exceptional 11, if you want to be alliterative. Then that's what, more than half of the market value of the S&P 500 potentially. So investors used to buy index funds, based on the notion that it gives you exposure to all different parts of the economy. You're obviously still getting that exposure, but it's really going to be intensely concentrated in a way that could spook some investors if there is an eventual AI pullback. I'm not talking about maybe dot-com bubble bursting type levels, but there are some people who are worried that maybe things are too frothy right now.
Paul, I appreciate you joining us, and I hope you have a great weekend.
Same to you guys. Really appreciate it.
That is Paul LaMonica from Barron's talking about the coming slate of tech IPOs.
I'll point out, Chuck, before you get there, in March of 2000, the tech concentration as a portion of the S&P 500 was close to 35% before the bubble burst, and it fell back down to 16% by September of 2002. To my knowledge, we're not far away from that right now, and certainly if these IPOs were added, you would be above that level of tech exposure in the index.
Mike, Tucker, whenever Tucker puts something in the stack 2 days in a row, it's a nice subtle message of, hey, cover this, you guys. So we're going to do that now. There's a piece from MarketWatch. Roast My House Reddit. Desperate home sellers are asking strangers for help getting offers. And I did think this is good in that, look, you've got people that are trying to sell homes in a more challenging environment nationally in which to do so now. And the ones that are not, having offers for their houses, they're basically putting the listing pictures up on Reddit and being like, hey, can you guys help me figure out what's wrong with my house so it'll sell faster? Which is kind of like, I don't hate the idea, to be honest.
Oh, I do.
If I'm Zillow, I jump all over this.
Why don't you like it, Mike?
I don't know. I don't like pictures of my home being out there, but I suppose if I'm listing it on Zillow, then
it's already listed,
there.
Michael.
Yeah, it's already there.
It's out there, man.
But you're right, Tucker. Zillow and Redfin should be taking advantage of this in some way because they have such a massive user database that they do not monetize in any realistic way.
We're done for the day and done for the week. Hope you all have a great weekend. We'll see you back here Monday. Hi, this is Chuck and Mike.